Hi, I'm Brian Greer. I'm a partner here at TaxConnex, and today we're going to talk about sales tax audits, and specifically what triggers a sales tax audit. One that I see that's fairly common is when your customer gets audited. So for example, you're sending out invoices to your customer. Now your customer is audited. The auditor is going to see your invoice. If they see an invoice that doesn't have sales tax on it, or maybe something looks a little bit unusual about the way you're charging sales tax, maybe it's not being charged correctly, that could certainly lend that auditor to come back to you to start asking questions and maybe open up an audit in your business. Now, this next one I'm going to talk about, I don't see it all the time, but I think it's just kind of an interesting example. A few years back, we had a company that came to us, and they were in the middle of a handful of sales tax audits. And as we started working with them, more audits popped up. And this is a company that had really no sales tax audit history prior to this event. And they were able to trace it back to a specific employee that was terminated for cause, and that disgruntled employee ended up essentially being a whistleblower and going back to all of these states and suggesting that the states audit this business, that they were doing something not necessarily correct. So it ended up being not a huge issue for them, other than the time and the expense and the effort to resolve those audits. Another example is that sometimes there's just a very specific industry that's ripe or targeted for audit. And a lot of times this happens after a new rule or some type of new legislation has been passed, again, specific to that industry. I've seen this happen in construction, in manufacturing, even in software, where a state will pass some specific legislation. They'll then go out to businesses in that industry to make sure that they're complying. The last one that I'm going to talk about is related to registering and starting to comply with jurisdictions. Most jurisdictions, if we look at economic nexus from a sales tax perspective, you have to have at least $100,000 in sales sourced into their state. And now you've reached that threshold, you've decided to register and start reporting sales tax. So what happened logically is $100,000 over a 12-month period is a little bit over $8,000 a month in sales activity. Now, if all of that is subject to sales tax, assuming an 8, 9, 10% tax rate, you're looking at something less than $800 a month in sales tax that would be reported. So if you register and you start reporting $5,000, $10,000 a month in sales tax, that can look a little bit odd to those jurisdictions and might trigger an audit. So hopefully these are good pointers. Again, there's no hard and fast rule here. You might go the rest of your life and never be audited, or you might get audited tomorrow. Really the best approach is assume that there's going to be some type of audit at some point, and make sure you've got all your books and records in place. Make sure that if you do have exempt transactions, you're collecting those exemption certificates and doing the best you can just to follow the sales tax rules. So if you have any questions related to sales tax, feel free to reach out to us. Feel free to reach out to me personally. We'd love to chat with you and see if we can help in some way.